Hey everyone, Ben here and welcome to Motivation to Invest. Is there going to be a market crash or correction very soon? Is now a good time to invest or should you wait for a major market crash or correction? Well, in this video, we're going to find out as I'm going to deep dive into 10 economic indicators to help to establish where we are in the current market cycle. Now, paraphrasing one of the world's greatest investors, Howard Marks, he once stated, predictions are very difficult, especially those about the future. But knowing where we are in the present can help to give us an indication of where we are in this current market cycle. So before we dive into that, if you're new around here, why not consider joining the investing family by hitting that subscribe button and turning that notification bell on. If you wish to take things one step further, feel free to hit that first link in the description below to be taken to the Patreon page where you can find out about the VIP membership group. There you can find out exactly when I'm buying stocks, exactly when I'm selling stocks, which stocks I'm buying and selling, and access my entire investment portfolio. You can even talk to me directly about your own portfolio and situation. So if you're interested in that, check out that first link in the description below. But with that being said, let's dive in. Right guys, so let's kick things off at indicator number 1. Now this is a technical indicator we're going to dive into. Now this is the Fear Greed Index. Now as you may know, the stock market is driven in the short term by fear and greed. Sentiment drives prices in the short term, and in the long term, fundamentals drive prices. So here we can see the Fear Greed Index. It looks at a variety of different indicators such as stock price strength, market momentum, put and call options, stock price breadth, market volatility, safe haven demand, junk bond demand, and many, many more. So currently we're at greed of 67. Now, that might sound bad, greed at 67, but honestly, I've been watching this indicator for a while. Over the past few months, 67 is not too bad. 1 month ago, it was also at 69, similar level. 1 year ago, it was at 86. So just before the 2020 market crash, there was actually extreme greed in the market because we'd been on the longest bull run in history. There was no sign of a market crash in sight. And then the black swan events, this global health crisis, came and crashed the market. But this indicator did predict that as they were extreme greed 1 year ago. So as you can see, I'm going to put these indicators into a chart to give us a bull thesis and bear thesis on the current condition of the stock market. So the Fear Greed Index is the first indicator we're going to be looking at. And as you can see, that's not too bad. It's a little bit on the greedy side. So I'm going to give that a neutral point, but slightly over towards the bear market side because we're still greedy, but it's not too bad at the moment. So indicator number 2, which is another technical indicator, we're going to dive into the VIX, which is the Volatility Index. So this represents the market's expectation of a 30-day forward-looking volatility. Many people call this the fear gauge or the fear index, and this has been very indicative of many previous market crashes. So firstly, what is volatility? Well, volatility is basically the up and down price movements of a stock. Now, many great value investors do say that volatility is not risk, and I do agree with that. Just because the stock market is volatile, going up and down a lot, that doesn't mean it's more risky. But it does seem like that when you're investing. So if you're investing into a stock and it's very volatile, it can be very stressful. When this indicator is above 20, so 20 is the key level. So when it's massively above 20, that's when there's a lot of volatility, there's a lot of fear in the market, and that is when you should actually be buying heavy. So as the world's greatest investor, Warren Buffett, once stated, be fearful when others are greedy, and greedy when others are fearful. So when there's a market crash, surprisingly, that's the time you have to go against the tide and you should be investing into quality companies as long as those companies' fundamentals haven't changed. So for example, here, March 2020, we can see here, the VIX index spiked to 80. So it was way above 20. This was the best time to buy because in fact, when stocks have crashed, they're actually at cheaper prices. They're at better valuations than previously. So that is when you can actually get really good deals on stocks. You would have seen me investing heavy into stocks during that time and making major gains in the market. But there's also little corrections we can look out for. These can be also great buying opportunities if you're dollar cost averaging into the market. So as you can see here, there was a little spike here, and then there was a little spike here. This was probably the tech sell-off. So this point here, this was when the vaccine was announced and there was a bit of a tech sell-off as people were transitioning over to more cyclical stocks as they thought the economy is going to reopen very soon. So that was a little sell-off there. So these are just little opportunities we can watch out for. But we also need to look at when is a good point to take some profits, sell, or even rebalance our portfolios. For March 2020, so this was like February time here, and it dropped below this 20 line here. So it dropped below this 20 line. Now, that was actually the best time to sell. And as you would know, if you would have sold your stocks right here, you wouldn't have been impacted by this market crash here. And then you could have bought back in at low prices. Now, that is timing the market. But I was actually looking at a variety of these indicators, which I'm going to explain to you guys in this video. And personally, I was completely out of the market in February 2020. I had no stocks in the market. I'd sold everything just because I'd seen all these indicators that I'm going to analyze in this video. I'd looked at the valuations, I'd looked at the VIX, and I said to myself, okay, I'm going to sell everything. And people were calling me crazy at the time. They said, Ben, we're on the biggest bull run in history. What are you doing? You're going to lose 50%, 20%, 30% a year if you're out of the market. And I said, no, I can see these indicators. I'm going to stay out of the market at least for a few months and just see how things go. The market crash happened and I bought back in very, very heavy. So this is the power of the VIX. Great technical indicator. You can look at it really fast and just gives you an indication of where we are. So first fundamental indicator we're going to check out is the Shiller PE ratio, or the price to earnings ratio. So the Shiller PE ratio is a price to earnings ratio based on the average inflation adjusted earnings from the previous 10 years. This is known as the cyclically adjusted PE ratio, or CAPE ratio. The dot-com bubble, now this is where valuations really went sky high. So the dot-com bubble, we're at a price to earnings ratio of 45 there. This is general for the market. Today, where are we at today? So we're at 34.5 today. So I wouldn't say the market is cheap today. It's definitely not. So if this price to earnings ratio was at this 45 point here or above, I would be really worried because I'd be thinking, okay, why is that the case? It's still higher than it has been in the past, let's say 100 years. But is there reasons for this? And I do believe there is. Yes, it may look expensive, but the tech giants make up around 25% of the S&P 500. So that's your Amazons, your Facebooks, your Google, Alphabet, and even Tesla now. So they make up a large portion of the S&P 500. But there's still a lot of companies in that index which are undervalued. So I'm actually going to put that on the bear side, but I wouldn't worry about it too much. But we're going to get onto the other indicators and all will become clear very soon. So the next indicator we're going to look at is the Buffett indicator. So this basically takes the percentage of total market cap, TMC, relative to the United States gross national product. And according to Warren Buffett, this is why it's called the Warren Buffett indicator, this is probably the best single measure of where valuation stands at any given moment. According to this, worryingly, the stock market is significantly overvalued according to the Buffett indicator. So we're going to give that one to the bears also. So that's the Buffett indicator does say the stock market is overvalued. But this is where things get interesting. So interest rates are also at an all-time low. The lowest it's ever been since 1971 has been 0.25%. And that is where we are today. The lowest interest rates have ever been. And this means money is cheap. Money is cheap for businesses, for people. There's a lot of stimulus in the economy right now. The credit window is wide open. But also for you guys, if you think about being an individual, you've got saved. You're going to keep those in a bank account earning 0.01% interest per year, or you're going to put it somewhere else into the stock market. You're not going to put it in bonds because bonds also have very low interest rates right now. So really the stock market is the only game in town. Next, let's go on to some real economic indicators. So what's the unemployment rate now? So this is interesting. So if we go back to 2008, employment just after the financial crisis spiked up to around 10%, which was incredibly high. However, if we look at what happened in 2020, it spiked up even higher to 14.8%. But the difference being here, I would say, is the economy was shut on purpose. It wasn't shut by an accident or some sort of catastrophic event. It was shut on purpose. The majority of those jobs which people may have lost, let's say from restaurants, from bars, in travel, the majority of those should come back once everything reopens. So if we look at 6.7, that's the same as it was in 2014. For this whole global issue, unemployment levels were at the lowest ever, so at just 3.5%. So really we want to be getting back down to that level, and that's really healthy for the economy. So I'm going to give that one a neutral point at the moment because it's still higher than it was pre-global health crisis. I still think there are a lot of jobs that people need to get back once everything reopens across the world. But now let's take a look at the initial jobless claims. So we can see that that has been falling. It's also been falling here. If this starts increasing massively, then that will be a worrying sign because that could mean the vaccines aren't working or there's some major issue going on. It's still decreasing at the moment, so it's not looking too bad. So I'm going to give that one to the bulls. Next, we're going to take a look look at the Consumer Confidence Index. And you may know this already, but the economy is driven by consumerism. And that's a good indicator of where we are in the current market cycle. An interesting way of explaining this is what you spend is somebody else's salary. If you think about it, more people are out there shopping, which means they're more optimistic about the situation we're in with the economy, the more confident. So the Consumer Confidence Index here, we can see, obviously it dropped off a cliff in March 2020 as people didn't know what was going on. I think the only thing that people were buying then was toilet paper for some reason. But yeah, as you can see here, it's started to spike back up again, which is good. There has been a little bit of a dip here. I reckon this little dip here was potentially due to when it was announced on the news that they found a new strain for this virus. But overall, it has been increasing, so that's a good sign to see. It'd be great to see it back at these levels, and then we can be pretty confident about the market. So I'm going to give that to the bulls also because it has been increasing over time. There's been a slight little blip, but nothing too bad. If you guys have found value in this video so far, please give it a big thumbs up. That helps out tremendously with the YouTube AI. Next, we're going to take a look at manufacturing. So we're going to dive into the ISM Manufacturing Index. And think about this, if more companies are making stuff, that means more people are buying stuff. And as I mentioned previously, what one person spends is another person's wage. So manufacturing index here, basically anything above 50 is good. That means the economy is booming. That means manufacturing is increasing. People are buying more. Factories are making more stuff. During the March-April crash, it dropped down to 41.5. Factories stopped. People didn't know what was going on. A bit of limbo in the economy. So we're at 60.7 now. So that's looking pretty good also. So I'm going to give that one to the bulls also. So looking at the fundamentals so far for the economy, we can see, yeah, the Schiller PE does say we're overvalued. Buffett indicator does say we're overvalued. But interest rates are low. Unemployment's middle ground. It could do better. Initial jobless claims are decreasing. Consumer confidence is increasing. And manufacturing is increasing. So overall, it's looking quite good for the economy. And finally, I'm going to dive into one more indicator. So this is whether the yield curve is inverted or not. So basically, an inverted yield curve is when the yields on bonds with a shorter duration are higher than the yields on bonds that have a longer duration. So in normal times, investors are happy to take lower interest rates when their money is tied up for shorter durations. But when the yield curve inverts, this is when investors have little confidence in the near-term economy and they demand higher interest rates for short-term investments. Now, the yield curve's a really interesting one. So as you can see here, an inverted yield curve has predicted the past 7 recessions. So back in the 1980s, you can see a major inverted yield curve here. If we go back to the dot-com bubble, we can see just before that bubble popped, the yield curve inverted and then boom. 2020, the yield curve did invert slightly. It wasn't major, but it did invert just before the 2020 market crash. So this is a very interesting one to look at. So I'm sure you guys are wondering, what is the yield curve like right now? So the yield curve right now is healthy. It's normal. As you can see, people demand higher interest rates when their money is tied up for a longer period of time. So what are my final thoughts? Well, overall, from the economic indicators and the technical indicators we have analyzed, we can see the economy is quite healthy and does seem to be improving. So what am I personally doing? Well, I'm going to continue dollar cost averaging into the market into exceptional companies at fair prices. However, I am going to be cautiously confident. So I'm going to be confident, but not as aggressive as I was back in the March-April 2020 crash. Then I was going hard. And if anything, I wish I went harder. So I hope you guys found this video valuable. If you did, feel free to give it a big thumbs up. That helps out tremendously with the YouTube AI. If you're new around here and you still haven't subscribed, why not consider joining the investing family by hitting that subscribe button and turning that notification bell on. If you want to find out exactly when I'm buying and selling stocks, in addition to accessing my entire investment portfolio, feel free to hit that first link in the description below to be taken to the Patreon page and find out more about the VIP membership group. I'd also love to hear your thoughts, so please do comment your thoughts below on the state of the economy right now and the stock market. Do you think are people overly fearful or overly greedy? Just comment below, greed, fear, or in the middle. And with that being said, I hope you guys have a tremendous day and I'll see you in my next video. Invest safe.